Hey there, curious minds. Ever wondered how we know we can genuinely trust the financial numbers we see from big corporations or even the nonprofits we support?
Yeah, it's a great question.
It's not just leap of faith, right? It's actually built on the meticulous, often unsung work of auditors. And they're all guided by a pretty robust framework of professional standards.
Exactly.
So today we're taking a deep dive into that fascinating world, really peeling back the layers to understand how financial information gets its credibility.
That's right. Our mission today is to truly demystify how something as critical as, say, a company's financial health becomes trustworthy in the first place.
Hmm.
We'll try to cut through some of the complexity, the rules and processes, and give you the essential insights so you understand not just what happens in an audit, but why it profoundly matters to you,
Whether you're an investor, a
or,
donor.
or just someone relying on public info.
Yeah. Okay, let's maybe set the stage with a scenario you might actually face. Imagine you're making a significant decision. Maybe thinking about investing your hard-earned money in a promising new company.
Okay.
Or perhaps you're weighing a substantial donation to a nonprofit, one whose mission you really believe in.
Right. Happens all the time.
Both scenarios, they fundamentally rely on understanding their financial health, but how do you really know those numbers they're presenting are accurate, reliable, and not just, well,
Wishful thinking.
exactly, or, optimistic projections, or even worse?
This is precisely where the audit steps in. At its core, an audit is about an independent auditor providing an objective opinion
Okay, an opinion on what specifically?
on whether a company's financial statements are presented fairly and in all material respects according to a specific applicable financial reporting framework.
Okay, applicable financial reporting framework. That sounds technical.
It is, but think of it as the detailed playbook. So for
Yeah.
instance, in the U.S., most companies follow U.S. GAAP. That's generally accepted accounting principles.
Right, gap. Heard of that.
Or globally, you'll often see IFRS, the International Financial Reporting Standards. These aren't just suggestions. They're the comprehensive rulebooks for how financial statements must be prepared and presented.
So, if a company creates its own financial statements following these rules,
Yeah.
what gives them that stamp of approval, that sense of reliability for someone like me looking in from the outside?
It really boils down to independence. That's the key word.
Independence.
Yes. The financial statements are always prepared by the company's management. The auditor's role is completely distinct. They examine those statements and then express an independent opinion.
Ah, okay.
Without this unbiased, objective report from an external auditor, public trust in those statements would be incredibly low. They'd just be seen as self-serving, right?
Makes sense. Largely meaningless if it's just the company marking its own homework.
Pretty much, yeah.
Okay, so we have management putting the numbers together, following the rules, and an independent auditor checking them. What are the distinct responsibilities here? Who truly owns what part of this dance of digits?
Well, the primary accountability for the financial statements themselves, that lies squarely with management.
Okay.
They are responsible for preparing and fairly presenting those statements, meticulously following the chosen financial reporting framework.
Right.
This also includes the vital task of designing, implementing, and maintaining strong internal controls.
Internal controls, like checks and balances within the company.
Exactly. The systems and processes put in place to prevent significant errors or, even fraud.
Mm.
And crucially, management must provide the auditor with complete and unrestricted access
Access to what?
to all necessary information, records, and personnel needed to conduct the audit. I mean, the very act of preparing these statements fairly requires management to identify the correct framework, stick to it, and clearly state in the financials which framework they've used.
That makes sense. So management sets the stage, does the groundwork. But what about the auditor? What's their job description beyond just giving that final opinion? Because it sounds like a huge amount of responsibility being that trusted, independent eye.
It absolutely is. The auditor has several critical responsibilities. First and foremost, they have to maintain what we call professional skepticism.
Professional skepticism. Okay, what does that mean in practice? Not just being cynical.
No, it's not cynicism. It's a vital attitude. The auditor doesn't assume management is dishonest, but crucially, they don't unquestioningly assume honesty either. They have to critically assess all the audit evidence they gather.
So always questioning.
Pretty much. Constantly being alert for evidence that contradicts other information they have, questioning the reliability of documents, spotting conditions that might indicate fraud, or recognizing circumstances that signal a need for more audit procedures, beyond what they initially planned.
That sounds like a constant detective mindset.
That's it.
Why would that be a challenge? Wouldn't auditors naturally be skeptical? Isn't that the job?
You'd think so, but it's surprisingly difficult in practice. There are some very real human impediments to consistently acting with professional skepticism.
Like what?
Well, for instance, unconscious human biases can creep in. An auditor might unconsciously favor information that supports the client's view over, say, an investor's, or look for evidence that confirms what they already think rather than challenging it.
Confirmation bias.
Exactly. And this can be fueled by pressures, the desire to keep a client happy, maybe the need to issue a clean audit opinion, or even just pressure to keep audit costs down.
Right.
There's also the subtle challenge of maybe building too much trust or confidence in management over time, which can lead to not asking those really tough, probing questions.
I can see that.
And let's be honest, just avoiding negative interactions with people you work with regularly can sometimes be a factor too.
Yeah.
And finally, practical things like tight schedules and heavy workloads. Sometimes that can lead auditors to maybe take shortcuts, perhaps seeking easier to get evidence rather than the most reliable evidence, or not giving enough weight to stuff that contradicts the main story.
Wow. Okay, that's a key aha
Mhm.
moment for our listeners, I think. It's not just about applying rules, it's about overcoming some very human tendencies.
It really is.
So, what else is crucial for an auditor besides fighting off those biases?
Well, beyond skepticism, auditors are bound by strict ethical requirements, most notably independence, both in fact and appearance.
In fact, and appearance, what's the difference?
Independence, in fact, is about their actual state of mind being unbiased. Independence in appearance is about how others perceive their independence. Both are critical.
Okay. Non-negotiable for credibility.
Absolutely. Standards like the AICPA Code of Professional Conduct lay out these detailed rules. Third, they must constantly exercise professional judgment throughout the audit.
Judgment. Where does that come in?
Oh, everywhere. Deciding what information is material or significant to users. Assessing audit risk, where might things go wrong. Determining what specific procedures to perform. How to evaluate management's often subjective estimates, like depreciation or bad debts. And ultimately, how to draw sound conclusions from all the evidence gathered.
A lot of judgment calls.
A huge amount. Fourth, they're responsible for obtaining sufficient appropriate audit evidence, meaning enough reliable evidence that's actually relevant to what they're testing.
Sufficient and appropriate. Got it.
And finally, they must comply with generally accepted auditing standards, or GAS. That's the overarching framework guiding their work. Though, depending on the job, they might also follow other standards like PCAOB auditing standards for public companies, government auditing standards, or international standards on auditing, IS.
Okay, GAAS. That brings us to what sounds like a massive library of rule books then. It really is like there's a different playbook depending on the specific game or type of financial statement being audited.
Exactly. That's a good way to put it. These professional standards are the detailed rule books auditors follow for various types of engagements, each tailored to the specific context.
So if I'm running a small private company, the auditor follows one set of rules, but if I'm, I don't know, Apple or Google, it's a completely different rule book they're using.
That's basically it, yeah. It reflects the varying levels of public interest and, frankly, regulatory oversight. Let's maybe walk through some of the key distinctions for different types of audits.
Good.
For general financial statement audits, we mainly have two major sets of standards in the U.S.
Right.
First, statements on auditing standards, or SAS. These are set by the AICPA's Auditing Standards Board. Now, these standards apply to audits of non-issuers.
Non-issuers, so private companies.
Typically private companies, yes. Those whose stock isn't traded on public exchanges. SAS provides the generally accepted auditing standards, or GAAs, for their annual historical financial statements, and even guidance for interim financials if the annual ones are also audited.
Okay, SAS for private companies. What about the big public ones?
That's where PCAOB auditing standards, or PCAOB-AS, come in. These are set by the Public Company Accounting Oversight Board, the PCAOB.
PCAOB, right.
Crucially, these apply specifically to audits of issuers.
Issuers meaning publicly traded companies, the ones you can buy stock in.
Exactly. The PCAOB was actually created specifically to oversee the audits of these public companies, after major financial scandals like Enron and WorldCom. So their standards are often more prescriptive, more detailed, really designed to protect public investors.
Got it. So S for non-issuers, PCAOB for issuers. Are there others?
Yes, there are specialized audit standards for unique situations too.
Like what?
Well, there's generally accepted government auditing standards, or GAGAs, often called the Yellow Book.
Yellow bow.
These are set by the Governmental Accountability Office, the GAO,
Mhm.
and as the name suggests, they apply to audits of government organizations, programs, activities, or really any entities that receive significant government funding.
So city government, state agencies.
Exactly. And these often have additional requirements, maybe focusing more heavily on compliance with specific laws and regulations, or even efficiency and program effectiveness.
Interesting. So that covers full-blown audits. But you mentioned other types of work accountants do, things that aren't quite a full audit.
Good question. Yes, accountants provide other valuable services that offer different levels of assurance, or sometimes no assurance at all.
Okay.
So we have statements on standards for attestation engagements, or SSE. These are also set by the AICPA. These apply to what we call attestation engagements.
Attestation. What's that?
It's where an accountant issues a report, maybe an examination, a review, or based on agreed-upon procedures on some specific subject matter that's really the responsibility of another party.
So not the main financial statements.
Right. For example, an auditor might provide an opinion on how effective a company's internal controls are over financial reporting, or maybe their compliance with environmental regulations. It's providing assurance on something other than the whole set of financial statements.
Okay, that makes sense. Anything else?
Then there are statements on standards for accounting and review services, or SRs, often pronounced STARS.
SRs, okay.
These are set by the AICPA's Accounting and Review Services Committee. Now, these apply to unaudited financial statements or financial information, specifically for non-issuers.
Unaudited.
Right. This covers services like simply preparing financial statements for a client or compiling them, which means putting management's information into financial statement format without expressing any opinion or assurance, or performing reviews.
What's a review?
A review is less extensive than an audit. It involves inquiries and analytical procedures, and it provides limited assurance saying nothing has come to the accountant's attention suggesting the statements need material modification. It's less assurance than an audit, but more than a compilation.
Okay, so different levels of scrutiny.
Exactly. And finally, there are overarching ethical and quality guidelines that kind of sit above all these activities.
Like what?
Well, the AICPA Code of Professional Conduct is the ethical roadmap for all AICPA members. It ensures high standards of integrity, objectivity, independence, all that crucial stuff.
Right, the ethics code.
And statements on quality control standards, or SQCS. These guide the CPA firms themselves on setting up robust internal quality control systems.
Quality control for the whole firm.
Yes, to ensure the firm and its personnel comply with professional standards consistently and issue reports that are appropriate in the circumstances. It's about quality at the firm level.
So it's not just one big flat stack of rules then. You mentioned GSS, PCAOB. Sounds like there's actually a hierarchy, a kind of ladder of authority that auditors rely on when they're making judgments.
Absolutely. That's a really important concept. When auditors are navigating complex situations, maybe where the standards aren't crystal clear, there are 3 levels of authoritative guidance, from most to least important.
Okay.
And this hierarchy is crucial. It ensures consistency across audits, provides accountability, and it guides an auditor's professional judgment.
So what's at the top? The most important stuff.
At the very top, the most authoritative guidance includes the SS for non-issuers and the PCAOB for issuers. These are the standards themselves. And the language here is really key.
No, so.
If the standard uses words like must or is required, that signals an unconditional requirement. It has to be followed in all relevant cases. Virtually no exceptions allowed.
Okay, must means must.
Right, but if it says should, that's what we call a presumptively mandatory requirement.
Presumptively mandatory.
It means it must be followed unless there are extremely rare circumstances where departing from it is justified. And even then, the auditor has to perform alternative procedures to achieve the objective of that requirement and document everything thoroughly why they departed what they did instead. So should indicates a very high bar for doing something different.
So should is almost like must, but with a tiny escape hatch if absolutely necessary and well documented.
That's a good way to think about it. And then words like may, might, or could, those are just explanatory. They describe possibilities or actions, but they don't actually impose a professional requirement to do them. Understanding this linguistic nuance is vital for an auditor.
Okay, so that's the top tier. What's next down the ladder?
Next, we have interpretive publications. These are essentially recommendations or guidance on how to apply those top-tier standards in specific situations. They aren't auditing standards themselves, but auditors should consider them.
Should consider, so not mandatory like must or should.
Right. But if an auditor chooses to depart from interpretive guidance, they need to be able to clearly explain why and how their actions still complied with the overall higher-level SAS or PCAOB standards. Examples might include AICPA auditing interpretations or detailed audit and accounting guides for specific industries.
Okay. And the bottom level.
Finally, at the least authoritative level, we have other auditing publications. These have no official authoritative status at all, but they can still be incredibly helpful.
Like what kind of things?
Think of journal articles, textbooks, materials from continuing professional education courses. They can provide valuable context, new ideas, or deeper insights into applying the standards. Auditors should consider these too, but again, they must be able to justify any departures if they choose not to follow advice found there.
So this whole hierarchy helps ensure that while auditors use judgment, it's within a really clearly defined, rigorous framework.
Exactly. It provides structure and accountability.
That deep dive into the hierarchy really highlights the thoroughness required. But, even with all these rules and these meticulous processes, you mentioned earlier that there are some things an audit simply cannot promise. So what does reasonable assurance actually mean? And why isn't it an absolute guarantee?
You've hit on a really critical point there.
Mhm.
An auditor provides reasonable assurance, which is defined as a high, but crucially, not absolute level of assurance.
High, but not absolute. Yeah.
Assurance about what? That the financial statements are free from material misstatement, whether that misstatement is due to simple error or intentional fraud.
And how do they get to that high level?
Well, to achieve reasonable assurance, the auditor undertakes significant work, meticulous planning, proper supervision of their audit team, determining and applying specific materiality levels throughout the audit.
Materiality meaning what's important enough to matter to a user.
Precisely. Identifying and assessing the risks of material misstatement, where could things likely go wrong, and then diligently obtaining sufficient appropriate audit evidence to address those risks. It's a comprehensive process.
So maybe analogy. If I go to the doctor for a very thorough annual health checkup with all the tests and exams, that gives me reasonable assurance about my current health, right? Based on everything they looked at.
Sounds reasonable, yeah.
But it doesn't guarantee I'll never get sick in the future or that they didn't miss something incredibly rare, even if everything looks perfectly healthy today. Is that a fair way to think about audit assurance?
That's an excellent analogy, a really good way to conceptualize it.
Yeah.
And that brings us directly to the inherent limitations of an audit. These are the fundamental reasons why absolute assurance is simply impossible, even for the most diligent, competent auditor.
Okay, what are these inherent limitations?
Well, first, there's the nature of financial reporting itself. Many items in financial statements just aren't black and white. They involve management's subjective judgment, estimates, or assumptions.
Like what? Give me an example.
Sure. How long will a piece of equipment last for depreciation purposes? What's the probability of collecting on a specific customer debt, the allowance for doubtful accounts? How do you value certain complex financial instruments? These involve estimation and judgment, introducing an inherent level of variability and uncertainty that no audit can completely eliminate.
Right, you can't audit a crystal ball.
Exactly. Second,
Is it?
there are inherent limitations in the nature of audit procedures themselves. Auditors face practical and sometimes legal limits on their ability to obtain every single piece of potential evidence. Well, management might inadvertently or even intentionally not provide complete information. And frankly, fraud, especially if it involves collusion or sophisticated forgery, can be incredibly cleverly concealed. It can be extremely difficult to detect, even with really good audit procedures designed to find fraud.
So they might just not find it, even if they look.
It's possible. And crucially, remember, an audit isn't a legal investigation. Auditors don't have subpoena powers like law enforcement or regulatory bodies might. They rely on cooperation and the evidence available to them.
Okay, that's a big one. What else?
And third, we have the practical factors of timeliness and cost benefit. Users need financial reports within a reasonable time frame to be useful for decision-making.
Can't wait years for the audit report.
Right. And an audit has to balance the significant benefit it provides, that increased trust and credibility, with its cost. It would be prohibitively expensive to audit every single transaction a company makes.
So what do they do instead?
It means auditors have to plan efficiently. They focus their efforts on areas most likely to contain risks of material misstatement risk-based auditing. And they use testing and sampling techniques rather than trying to examine 100% of everything. It's about being smart and strategic to get that reasonable assurance, not exhaustive to the point of being impractical.
So understanding these built-in limitations, the nature of reporting, the limits of procedures, the time-cost balance, that's absolutely key to knowing what an audit actually delivers and what its stamp of approval genuinely signifies.
Precisely. It frames a context for the audit opinion.
Okay. Now let's talk a bit more about how the type of company affects the audit process itself. We touched on issuers versus non-issuers for standards, but does the audit itself look different? Are all audits created equal, or do they significantly change depending on whether it's, say, a huge public company versus a smaller private business?
They absolutely change, yes. Again, it reflects the different levels of public interest and those regulatory requirements we talked about. While the basic scope of any engagement can vary, you might audit a single financial period, or multiple periods, or maybe even just one specific account balance right. The type of entity profoundly dictates the audit's required structure.
How so?
Well, for non-issuers, those generally private companies, they actually have a choice in many cases.
That choice about what?
They can opt for just a financial statement audit. That provides one opinion, the auditor's opinion on the fairness of their financial statements. Pretty straightforward.
Okay.
Or they can choose to have an integrated audit.
Integrated audit, what does that mean?
An integrated audit results in two opinions from the auditor. One is the standard opinion on the fairness of the financial statements, but the second is a separate opinion on the effectiveness of the company's internal controls over financial reporting, often called ICFR.
Ah, so they audit the control system itself, too.
Exactly. They test whether the controls designed to prevent or detect material misstatements in the financials are actually operating effectively.
Okay, so non-issuers can choose just financials or financials plus controls. What about issuers, the public companies?
For issuers, the public companies traded on stock exchanges, there's generally no choice. They must perform an integrated audit.
Must. So both financials and internal controls.
Yes, they have to have both audited. An integrated audit means the auditor assesses not only the financial statements themselves, but also those underlying systems and processes, the internal controls, designed to ensure the statements are accurate and reliable.
Why the mandatory integrated audit for public companies?
It really comes down to protecting the investing public. For public companies, the effectiveness of their internal controls is seen as paramount because it offers a critical ongoing layer of assurance to potentially millions of public investors who rely on those financial reports. Strong controls reduce the risk of nasty surprises.
That makes a lot of sense. More public reliance means more scrutiny needed.
Precisely. And it's also worth a quick mention that certain other entities have highly specialized audit requirements too. For example, ERISA plan financial statement audits.
ERISA, that's for employee benefit plans like 401ks.
Exactly. Employee benefit plans. These audits are critical for protecting employees' retirement savings. They ensure the plan is properly administered according to regulations, that assets exist and are valued correctly, and that specific procedures are followed for things like, say, certified investment information from qualified institutions. The public interest in protecting those retirement funds drives very specific audit requirements under ERISA and Department of Labor rules.
Okay, got it. So the specific rules and even the structure of the audit really tailor themselves to who relies on the information and what specific risks need addressing.
That's a perfect summary.
Wow. That distinction truly highlights how the level of public interest and regulatory oversight directly shapes the audit process and what ultimately gets reported. And there you have it, a pretty dynamic deep dive into the foundational elements of auditing.
Yeah, we covered a lot of ground.
We really did. We've seen how professional standards, those detailed auditor responsibilities like skepticism and judgment, and even the very nature of financial reporting itself, how they all come together to shape the trust we place, or maybe should place, in financial statements. It's truly a complex but really vital ecosystem, all designed to bring clarity and credibility to the numbers we rely on every day.
Indeed. And hopefully understanding these intricate layers, from the specific standards that apply to different companies to the crucial role of professional skepticism and professional judgment, and even being aware of those inherent limitations we discussed.
Right, the limitations are key.
It really empowers you as a user of financial information. It clarifies what that audit opinion truly signifies, its inherent strengths, but also its crucial boundaries.
So, thinking about our listener, what does this all mean for you? Well, the next time you encounter an audited financial statement, maybe for a company you're thinking of investing in, or a nonprofit you want to support, or even a government report you're reading, you now have a much clearer picture, hopefully, of the rigorous, very human, and structured process behind that seal of approval.
Mm-hmm.
It's not just about crunching numbers, is it? It's about the ethical backbone and the meticulously designed approach that aims to make them a reliable source of truth.
Which, thinking about it, raises maybe one last important question for you to consider. Given those inherent limitations we talked about, and that really crucial human element involved in maintaining skepticism, how might understanding all these details actually change the way you interpret and use any financial information, whether it's audited or not, in your own personal or professional decisions?
Ooh, that is a fantastic, truly thought-provoking question to leave with. Thank you so much for joining us on this deep dive today.
My pleasure.
Until next time, keep learning, keep questioning, and stay incredibly well informed.